So we're back. I'm with my good friend Charles. Charles, we took a look at a great duplex property. And, when it comes to acquiring units, right, because the whole point of this video series is called Carving Out Your Own Slice of Texas, right? It's about acquiring real estate to be part of your overall residential portfolio or commercial portfolio. And there's lots of opportunities throughout Texas. So what we saw was a duplex or 2 units. So in the residential space, you have up to 4 units, right? So you have a single-family residence or a 1-unit condo, and then you have a duplex, a 3-plex, and a 4-plex. Now, outside of that, you can get into the commercial world, which is 5+ units, right? So looking at it from an investment standpoint, you can go ahead and either look at a 2 to 4 unit place where you essentially are an investor because you rent out those other units and you can actually live in one of those units, right, at the same time and actually buy that particular property as owner occupied, which is huge, right? So I think that's a huge advantage, especially people that are just trying to get into the market. But you also go beyond that, right? You could buy a 10-plex, right? So you could buy an apartment building that has 10+ units, right? And then you are the landlord, you have all of the responsibility, but you also reap all of the rewards, right? So you have all of the appreciation and everything else. But what was really interesting, and you caught my attention, we were having dinner the other night, and you mentioned that there's a way where you could actually pool funds together, right? Which is really exciting. So tell us a little bit more about how someone can get involved in commercial real estate where they don't take on all the risk.
Okay. Happy to. Thank you, Ron. Yeah, there's so many different ways to get into real estate investing. One of the best ways, it's the way we actually got into it ourselves, is to do multifamily investing through syndication. And what you do then is you join a group or a pool, a syndicate, and rather than taking on the risk of buying a 15-unit or 100-unit property yourself, you do it as a group, and there'll be a lead investor that is in charge, and they're going to have a lot of knowledge that you probably don't have yet. So you benefit from their knowledge, and you get to invest that way along with the group, but you don't have the oversight, and you don't have to manage it. You've got, the lead investor is going to manage that. Or if it's big enough, you can even hire companies that specialize in managing it for you, for the syndicate. But it's a great way to enter the market. We're frequently referred to as passive investors, where you've got cash, you want to get into multifamily, you know how great it is of an investment, but you're not ready to buy a 20-unit building yourself. Join a syndicate and go that way, and we can help you find the right syndicate group for you to join, and it's a great way to get started.
It's extremely interesting. And, when it comes to the type of investor that can get involved in a syndicate, there's a term, accredited investor. Yes. So tell us a little bit about those baseline rules.
Oh, I have to go from memory. Baseline rules, to be accredited, you have to have a certain amount of money in the bank, or high enough income, and I believe, I'm going from memory, it's $300,000 a year for the past 2 years, and I don't remember the net worth amount off the top.
$1 million.
Is it $1 million?
That can include your business, your primary,
yes,
your primary home, and all
yeah.
that.
But there is another way with education that you can participate even if you don't meet those requirements. So that's offline subject, but there is another way. So, but most investors are accredited, and they invest, 50, 100,000 per deal, and they'll do, gosh, I know people that are in 25 deals, but you start with one, and beauty of multifamily or real estate in general is the group, the syndicate, is going to take this property and they're going to fix what's wrong. And that may be rehab. It might be management. And sometimes it's just whoever owns it wants to retire and get out. But you take over the property and you make it better, whatever better is, rehab, management, both. And you drive up that value. You may get a new tenant base. and increase rents because the property's better now. And as you drive up that property value, the group can do a cash out refinance. You can get a lot, sometimes all of your principal back, and you can go do another one. And that's really the idea, is you start with one, that turns into two turns into four, and you just keep driving up that value, cash out refinance, take that principal, put it into another property. So back to the first one, you've now got your principal out of it, but you're still getting checks every quarter. We call it mailbox money. So you're getting checks every quarter, and you have no money in it. You could, it's not technically true, but people refer to it as infinite returns because they have no money in, they're getting a quarterly check.
That's incredible. I mean, that's incredible when you think of, it's compounding, right? So it's essentially you're getting in, and that's really the key, is just to get in, right? That's step number one, and then once you're in, you have you take advantage of just the natural market of real estate, right? You have appreciation, you have the ability to fix the place up, that increases the value, that in turn increases the amount of rent you can charge, and you're able to use leverage for all of that. Right? I mean, that's fantastic.
And driving rent up just a little bit has a huge impact on the value of the property. So when you get in, you start learning the numbers. If you can increase rent $100, it is worth about 10 times that on the other side. So it's rent increase and justifiable rent increase is a huge piece to the puzzle.
Awesome. Thank you so much for sharing that.